The world's largest investment firm, BlackRock, just dropped its mid-year investment outlook for 2023. Do you want to know where the opportunities are for your portfolio? In this video, I'll break down the major themes, mega forces, tactical and strategical plays that BlackRock is betting on. And stick around till the end to get my key takeaways and how I'll be adjusting my portfolio based on this information. Okay, first off, I actually worked for BlackRock for 6 years across 2 different stints, and I know the firm pretty well. Every year, the BlackRock Investment Institute releases its annual investment outlook and also a mid-year investment outlook. And the BlackRock Investment Institute is essentially a platform where all the portfolio managers, investment teams, and investment professionals get together and they express their views on markets. In the latest report, BlackRock highlights 3 themes and 5 mega forces they believe investors should be thinking about. And they also disclose the tactical and strategic, that's short-term and long-term views on asset allocation that they use to influence how they build portfolios for clients.
Okay, so here it is, the 2023 Midyear Outlook from the BlackRock Investment Institute, which is titled New Regime, New Opportunities. So let's get into it. I'm going to skip past the intro slides and go straight to the main themes. So first theme is holding tight. According to BlackRock, we've moved to a new regime where supply constraints dominate the macro environment as opposed to demand shocks in previous years. These supply constraints will likely stoke ongoing inflationary pressures, they say, and keep that in mind for later when we get into tactical and strategic views on assets to invest in. This shift to supply constraints has 2 major implications, BlackRock says. So number one, central banks will likely have to hold policy tight to lean against inflationary price pressures. BlackRock now sees policy rates staying higher for longer in major economies. One positive here is that this means income is back, and you can see here on the right-hand side the direction of travel for US Fed policy rates and projections versus neutral estimates. And you can see on the far right-hand side of that chart just kind of how steeply rates have risen in recent months. The second implication that the economic relationships investors have relied upon could break down in the new regime. BlackRock says that a shrinking supply of workers in several major economies due to aging means a low unemployment rate is no longer a sign of cyclical health of the economy. And that could take a bigger toll on corporate profit margins, BlackRock says, compared to past where companies may lay off staff. In the new environment, they may have to maintain employment for fear of not being able to hire back workers when times are good. BlackRock says this creates a tough outlet for developed market equities. The key takeaway from this slide is that BlackRock believes finding granular opportunities within asset classes and not relying on the macro environment will be critical. Okay, so that's theme 1. Theme 2 is pivoting to new opportunities. So according to BlackRock, higher macro volatility is causing greater market volatility, which doesn't bode well for broad asset class exposures, they say. BlackRock sees dispersion within and across asset classes moving higher in the new regime, dispersion being the extent to which prices deviate from an index. And the chart on the right-hand side here shows that dispersion within the broad US equity index has ramped up significantly in the last 3 years compared to previous 10 following the financial crisis in 2008-2009. So according to BlackRock, this dispersion offers more ways to invest in uncorrelated securities and exposures. BlackRock also thinks this means security selection, expertise, and skill are even more important to achieving above benchmark returns. This suggests actively managed funds will see good opportunities relative to passive funds, which just track an index. BlackRock also believes relative value opportunities from potential market mispricing are likely to be more abundant. BlackRock says market narratives may switch more quickly in the new regime. So the key takeaway here is that BlackRock is eyeing opportunities on horizons shorter than a 6 to 12 month tactical horizon to maximize return potential. And that's a really big statement because, most industry professionals would really preach long-termism. And I don't think like contradicting that per se, but they're saying to maximize opportunities, it's really important to be nimble and to, look at opportunities on a relatively short time frame. BlackRock also holds the conviction that broad asset class exposures will no longer deliver the returns of the past. This idea of a rising tide raising all boats, they think investors really need to be more granular in looking for opportunities. All right, theme 3 is harnessing mega forces, and this is a big one. The BlackRock sees the new macro regime and asset returns being shaped by big structural forces. And I'm going to dive deeper into this, the 5 mega forces shortly. It says aiming to find sectors and companies that could benefit and track whether markets price this in yet. Or BlackRock says that it is aiming to find sectors and companies that could benefit and track whether markets price this in yet. They refer to the rapid adoption of historical technology advancements as indicative of how quickly the world can change. This is a great chart here showing just, how quickly electricity, telephones, cars, TVs, VCRs, cell phones, smartphones, etc., how quickly they were adopted. Kind of interesting they haven't got the internet here, but you can imagine if that line was on this chart, that would also show similar rapid growth. And I'm actually going to get into the 5 mega forces because I think each one deserves some attention. So the first one, I'll just to these slides. Okay, so the first one is digital disruption and AI. So BlackRock says AI or artificial intelligence and the digital disruption of established sectors and economies is going mainstream. So companies are increasingly talking about AI and seeking highly skilled workers with machine learning and AI expertise. In terms of components and kind of investing opportunities, they believe semiconductors, which are key components, AI tools and models, and the market excitement over AI's potential has triggered a sector rally. They believe more capital may flow into the production of semiconductors, especially as countries such as the US provide incentives to boost domestic production. Surprisingly, BlackRock thinks the importance of data for AI and the potential winners is underappreciated. That's quite a forceful statement. And again, they've got a great chart here just showing, the rapid rise in artificial intelligence mentions on company earnings calls, in the last quarter. So that's a really dramatic increase compared to the previous quarters. Just a couple other things to say. The wider range of tasks that can now be automated. I mean, companies deploying these innovations may boost productivity. That could be positive for stocks and for the economy. They say potential cost savings from automating some white-collar jobs and tasks to boost profit margins for companies. But they could also get left behind if they don't adapt. That is, companies could get left behind. So a slightly mixed picture, but undoubtedly a huge force driving market activity and potential returns. Okay, the second mega force is a fragmenting world. So here BlackRock says we are witnessing a new era of geopolitical fragmentation and competing defense and economic blocs. This is a marked departure from the globalization and geopolitical moderation of the past Cold War period. And you can just see here on this chart what they're talking about in terms of world trade as a share of GDP really rising before the war, World War I and World War II, then dropping during those years between 1914 and 1945, and then again rising very steadily really up until about 2008, 2009 financial crisis, and we've really seen that kind of deglobalization playing out in terms of world trade. So other things that they mentioned, the Ukraine war and fraught US-China relations have ushered in this new era. We see a world where national security and resilience are favored over efficiency. Without tech-driven productivity gains, BlackRock believes this will likely result in lower growth and higher inflation with big implications for portfolios. BlackRock also sees industrial and protectionist policies spurring investment in infrastructure and robotics, so those sectors could benefit. BlackRock also sees a surge in investment in areas like technology, clean energy, infrastructure, and defense that could create opportunities. However, the economic cost could rise longer term, particularly in emerging markets. So the big takeaway they say is that investors will need to be more cautious in targeting themes set to benefit from these trends. They also see opportunities for, developing markets. So countries like the Gulf oil states, India, Brazil, Vietnam, and Mexico all have valuable resources and supply chain inputs, BlackRock says. And lastly, for this section, BlackRock believes investment opportunities exist as the West pursues greater self-sufficiency in some areas like tech and energy, as mentioned before. So fragmenting world, very important to be aware of. The next the next megaforce is tracking the low carbon transition. So here, BlackRock sees a massive reallocation of capital as energy systems are rewired in the transition towards a decarbonized economy. BlackRock sees faster transitions in developed markets than emerging markets because of the lower cost of capital, a greater share of easier to decarbonize sectors, and more stable total energy demand. BlackRock expects inflationary pressures in coming years as higher energy prices combine with increasing capital spending. However, this may dissipate over time as low carbon technology costs decline, they say. And BlackRock also sees opportunities across the energy system, both in high carbon and low carbon sectors, again in front of shifts before markets. And you can see here the chart that they present, which shows the dramatic growth in electric vehicles, the company market share, and the percentage of the total market share. Okay, moving on to, aging populations. This is a really interesting one. BlackRock highlights major demographic shifts in its midyear outlook as populations age, particularly in developed markets. This shift is set to have profound implications for economies and investment opportunities. Many developed markets, including the Euro area and China, are facing a falling working age population in coming years. And you can see that in this chart, just how different the kind of change in working age populations are going to be for those developed markets compared to countries like India, for example, or the lower middle income countries in the world. They say fewer working age people limits how much an economy can produce and grow, and leaves fewer workers to support a larger non-working population. And this demographic shift impacts government spending and debt. BlackRock says per capita revenue from income tax falls as spending on retirement-related benefits like pensions and healthcare rises. This could lead to more government borrowing at a time when rising interest rates are already increasing debt burden. Aging could also prove inflationary. So BlackRock sees opportunities in healthcare, real estate, leisure, and companies with products and services for seniors. Investors may also consider how countries and companies are adapting differently. Okay, so Megaforce 5, the future of finance. BlackRock says in its 2023 midyear outlook that there has been a tectonic shift in the financial sector since the 2008 global financial crisis. Banks are gradually losing their dominance amid new regulations, technologies, and competitors. This year's banking tumult is a catalyst that is likely to create opportunities for non-bank lenders, they say. You can see here on this chart, they go on to explain that in 15 months, about $1 trillion were left US bank deposits, or about 6% of the total. And they explain this by showing that money market funds have been quicker to offer higher interest rates during the Fed's rapid rate hikes. So you can just see a very stark kind of inflow into money market funds versus outflow for bank deposits. BlackRock also notes regulatory changes in financial markets. Infrastructure changes present opportunities in private markets, including direct lending or finance negotiated directly between a non-bank lender and borrower. And BlackRock expects more borrowers to turn to private credit as it becomes relatively better priced. So longer term, BlackRock sees risks to banks. That's quite a big statement. They believe that regulation, more concentration, competition for deposits, and disintermediation of payments all have the potential to reshape the future of banking and finance. So in conclusion, we're seeing a significant shift in the financial sector, BlackRock says, with non-bank lenders stepping in to fill the void left by banks. Okay, so what does this mean for their strategic and tactical views? So this slide is really a key slide. It shows the difference between how they see asset class areas and across the short and long term horizon. So BlackRock has a modest tactical underweight to developed market equities based on the view that a growth slowdown anticipated over the next year isn't priced in. And you can see that that's the little pink square there versus the yellow square on the left-hand side for strategic views. They prefer emerging markets instead of developed markets, which you can see just here, which is the tactical overweight. They like quality as an investment factor. I'll do another video on factors, but now you just need to know that the quality factor refers to the tendency of high quality stocks with typically more stable earnings, stronger balance sheets, and higher margins outperform low quality stocks over the long term horizon. However, BlackRock says strategically they are overweight developed market equities, as longer term investors can look past some of the near term pain. So that's that comparison at the top, pink versus the yellow. BlackRock also says in government bonds, the return of income is a core BlackRock view on both horizons, so short term and long term. And in BlackRock's view, higher for longer policy rates have bolstered or strengthened the case for short dated government debt in portfolios on both tactical and strategic horizons. They stay underweight nominal long dated government bonds, so those are government bonds that aren't linked to inflation, on both horizons, as they expect investors to demand more term premium. And tactically, they have turned more neutral on the euro area and the UK government bonds, where pricing better reflects their view. In credit, BlackRock is neutral on investment grade credit, but sees it playing an important income role in portfolios on both horizons. They have upgraded private markets income to strategic overweight. So you can see that there, the yellow square just at the bottom. And for investors with a long-term view, they see opportunities in private credit, as private lenders will help fill the void left by banks pulling back. And even though they are underweight in growth private markets, they see areas like infrastructure equity as a relative bright spot. Okay, so you can see here they have much more granular tactical views. This would take a long time to go through, but what's great about this is they dive deeper into each of those kind of big areas. So developed markets get split by US, Europe, UK, Japan, Asia Pacific excluding Japan, and then developed markets, AI, Megaforce. That's kind of interesting. They busted that in there. And then in emerging markets, you can see they've broken out China, which has long been a kind of a sort of favored region for BlackRock to develop its product set in. And then in fixed income, you can see the different kind of sub asset classes there. And again, what's great about this chart is you can see how their views have changed. So what's interesting, short dated US Treasuries, they're still overweight tactically, but they're less overweight than they were. They have less conviction compared to 6 months ago when they released their annual outlook. And again, somewhere like Japan, tactically, they were previously underweight and now they're neutral. The same for Euro area government bonds. So really, really great kind of insight into how the world's largest asset manager is thinking. All right, and then I'm going to just roll back a little bit here to kind of strategic views. I think, they have a great slide here on how they think about building portfolios in terms of starting with broad asset allocation, then getting granular into, how much the macro outlook is priced in. And then they also kind of overlay their views on those mega forces that I mentioned. All right. And I think one thing I just also want to just draw your attention to is just how much their strategic views have changed. So strategic views, you know, I guess in common terms, are thought to be very long term. They're often, when pension funds do strategic asset allocation reviews, they typically do those every 3 years. And I think what's really great about this chart here is it shows just how much BlackRock's strategic views, their long-term asset allocation views, change on a 6-monthly basis. That's what the little dots are. I'm pretty sure there's a 6-month gaps. Actually, it could be quarterly. I think there's a quarterly. So let me correct myself there. So every quarter, it looks like they're changing their strategic asset allocation views, and particularly things like global credit, massively, a massive change from significantly underweight to pretty significantly overweight and then back to neutral. So I think, delving deep into this is really informative and helpful.
So in conclusion, I think this provides a great roadmap for navigating the current market environment. Let me tell you my 5 key takeaways. So number 1, it seems like BlackRock's suggesting investors should be more dynamic with their asset allocation in this environment, rather than just buying like an S&P 500 ETF or a European stocks ETF. In my view, the best way for investors to do this is through dynamic asset allocation whole portfolio funds. And I'll do another video just on that topic because I think it's a really great area of the market for investors to look at. Number 2, super low risk and liquid money market funds are offering better returns than cash accounts, bank accounts, regular savings accounts. So it makes a lot of sense for investors to be parking savings in those accounts where they'll get a better yield. So my third takeaway is I think you want to be more selective when it comes to picking sectors, themes, industries, and individual stocks or securities. To me, this means actively managed funds should be your friend when paired with index investments or ETFs. And I'll do another video on active versus passive because I find a lot of the commentary on YouTube is too simplistic and actually often just plain wrong. The fourth takeaway for me is it makes a lot of sense to get exposure to those mega forces that BlackRock talks about. For example, the demographics in India, where the working age population is going to be growing over the next 10 to 15 years, that's very attractive for growth in that market, for economic growth, and for potential Indian stock market returns. So I really like mega forces like that. And then, of course, there's AI. A company like NVIDIA has, I think, gone up 198% this year. But if you look at the adoption of those previous technologies that BlackRock mentioned, there's potentially a lot of room to grow. I think mega forces is a really important takeaway for investors. And lastly, it looks like inflation is kind of here to stay. And really our job is to respond and adapt to it. For me, this means seeking assets which can provide an inflation hedge, which can kind of keep track with inflation and maintain your purchasing power. Okay, so what am I going to do with my money? Well, in my pension, I'm currently invested all in target date funds, which are good long-term products, and a lot of people are invested in those. For me, as a professional investor, I'm a chartered alternative investment analyst and investment management certificate holder. I am thinking about changing that to more dynamic asset allocation funds that I mentioned before. And I'm also intrigued by the idea of adding selective active exposures for technology, India, as I mentioned, and maybe some select commodity exposures and maybe even private equity through listed private equity funds. It's worth mentioning I do not like real estate or property now at all due to the kind of high rates environment and also some of the market dynamics around office occupancy in a post-pandemic world. There's fewer people going into offices now, and there seems to be a lot of pain in commercial real estate sectors, and I just don't feel confident that that's where I want to have my money in the short term. I may change that view in 12 months' time, but for now, real estate is not going to be in my portfolio. I'm based in the UK, and we have a tax-efficient stocks and shares savings scheme called an ISA, or an instant savings account. For that, I'm going to be putting the maximum amount I can into high-risk dynamic asset allocation, whole portfolio funds, because again, I just really like the kind of easy does it one portfolio in one trade of that strategy. I'm based in the UK, and we have something called a stocks and shares ISA, where you have I think it's a £20,000 allocation where you can put money in, and all of your investment returns are tax free. And so I'm going to be putting all of that into dynamic asset allocation, whole portfolio funds again. And to round out the picture, I'm also going to be putting my cash savings into premium bonds, which are essentially zero risk government bonds, which enter you into a ballot every month where you can win a lottery with various prizes from, I think, £25 all the way up to, I think it's £1 million. I'll also add, I just don't like cryptocurrencies right now. I think there are so many ways to lose money in cryptocurrency. It's just not a prudent investment. I don't see how any finance professional can recommend even a modest allocation to cryptocurrencies. I just find there's far too many ways to lose money, and I'm just not interested in that. All right, that's a wrap. Thank you so much for your time. I hope you enjoyed the video. Until the next time, keep investing selectively and effectively.